Welcome to the Deep Dive. We unpack earnings calls, pull out the key insights, basically give you what you need to know without you having to sift through hours of audio. Think of us as your shortcut to being genuinely informed. Today, we're diving into BANR Corporation's Q2 2025 conference call. We'll hit the numbers, management's thinking, and, what it might signal for the market. All right, let's jump right in. BANR Corporation, quarter ending June 30th, 2025. Headline number: net profit available to common shareholders, $45.5 million. That works out to $1.31 per diluted share. Now that's up from $1.15 a share same time last year, and just a tick up from $1.30 last quarter, Q1. What's driving that little bump?
Yeah, it's interesting. I think what really stands out is their core earnings power. If you look at the pre-tax, pre-provision earnings.
Right, the PTPP number.
Exactly. Excluding some adjustments, that hit $62 million for Q2. That's a big jump, 19% actually from the same quarter last year. And core revenue followed suit, up to $163 million versus $150 million year over year. So the underlying engine looks strong.
Okay, $62 million PTPP. That's pretty robust. And that performance gave them a return on average assets of what, about 1.13%?
1.13%, yeah. Which is, quite solid in the current banking climate. It shows good efficiency.
Yeah.
And beyond just the profit numbers, the balance sheet looks healthy too. They kept a really strong core deposit base that's key.
How much core?
It's sitting at 89% of their total deposits. That's sticky money, reliable funding. Plus, you saw decent organic growth. Loans up 5%, core deposits up 4% year over year. Not bad at all. And tangible common equity per share, that important cushion, grew 13% from last year. That supports the dividend they announced, 0.48 cents per share.
And it seems like others are noticing too. They mentioned getting nods from Forbes, Newsweek, JD Power, S&P Global Market Intelligence. That's good validation. But, accolades aside, looking at just these initial figures, anything give you pause, or is it mostly smooth sailing?
Well, it's mostly positive, definitely. But if you look closely at that 1 cent EPS increase from Q1,
yeah,
it was mainly driven by higher net interest income, which is good. But it was offset a bit by two things. One, costs from consolidating some back office space.
Okay, efficiency moves.
Right. And two, a slightly higher provision for credit losses. Now, that's not necessarily alarming.
Because of the loan growth.
Exactly. More loans naturally mean you set aside a bit more just in case. It's tied directly to that strong growth we mentioned.
Got it. And they also flagged positive operating leverage, right? That core PTPP income, up 6.6% just from Q1, and that 19% year over year jump.
Yeah, that's impressive leverage. Things are moving in the right direction operationally. Looking at the loans themselves, total loans grew by $265 million in the quarter. Portfolio loans specifically up $252 million. That's almost a 9% annualized growth rate.
Pretty strong clip.
Definitely. Their loan to deposit ratio finished at 87%. On the other side, securities decreased a bit, just normal cash flows there. Deposits did see a seasonal dip, though, down $66 million overall. Core deposits were down $40 million, and time deposits fell $26 million, mainly because they let some broker deposits run off.
Okay, so loans are growing fast, deposits see a seasonal dip. How did they fund that gap? You mentioned borrowings.
Right. They increased borrowings by $309 million, mostly through FHLB advances, Federal Home Loan Bank advances.
Ah, the FHLB. So explain that for us. What are those advances and what does using them tell us?
Yeah. They're essentially secured loans the FHLB provides to member banks for liquidity. It's a common tool. What's smart here, though, is how BANR used them. They have strong capital, so they actually called and paid back $100 million of subordinated notes, which were costing them around 5.5% all in. They swapped that debt for these FHLB advances, which are more in the, say, 4.5% range.
Ah, so they're saving on interest costs.
Exactly. Should save them about 100 basis points, 1 full percentage point on that chunk of funding. It's about optimizing their funding costs while meeting loan demand.
Makes sense. Okay, let's talk net interest income, NII. That increased by $3.3 million from Q1. Driven by more earning assets, you said.
Yeah, more assets earning interest. And the yield on those assets is also benefiting from that strategic shift. Getting out of lower yielding securities, putting more into higher yielding loans.
And the margin itself, the N&M.
Net interest margin, tax equivalent, held pretty stable at 3.92%, which is quite good, frankly, given everything going on. Loan yield specifically ticked up 5 basis points. You had adjustable rate loans repricing higher, plus new loans coming onto the books at rates better than the portfolio average.
Okay, but I thought I saw the average rate on new loans was actually down a bit, 7.27% versus like 8% in Q1.
Good catch. It was down from 8.01% to 7.27%. But management was clear this wasn't really pricing pressure. It was more about the mix of new loans. They did a higher percentage of owner-occupied commercial real estate and C&I loans this quarter.
Ah, relationship-type loans.
Exactly. So different mix, slightly different average rate, but not necessarily weaker pricing power on like-for-like loans. Funding costs did nudge up a bit, though, mainly due to those FHLB advances and the seasonal deposit dip.
Okay, let's shift to the loan portfolio itself and credit risk. Management sounded pretty bullish on originations.
Oh, yeah, very bullish. Originations were up 80% compared to the linked quarter. 80%.
Wow. Where did that growth come from?
It was really broad-based. Commercial real estate originations up a massive 484%. C&I up 96%, construction and land development up 43%. So loan balances grew by that $252 million in the quarter, the 9% annualized pace, driven mostly by owner-occupied CRE, C&I, and that construction book.
And the crucial part, how did credit quality hold up with all that growth?
Remarkably stable. Actually, delinquent loans declined. Went from 0.63% last quarter down to 0.41% of total loans. Adversely classified loans were also down.
That's definitely a positive sign. Suggests solid underwriting.
It does. Non-performing assets, NPAs, are still quite modest, 0.30% of total assets. Now, NPAs did tick up by $7 million in the quarter, but they attributed that mainly to a few 1 to 4 family residential properties taking longer to resolve because of consumer protection rules. Not a widespread issue, it seems.
Okay. And the provision for losses.
$4.8 million net provision, mostly driven, again, by just having a bigger loan book due to that strong growth. The overall allowance for credit losses covers 1.37% of total loans, which feels like stable, solid coverage.
Management also talked strategy, didn't they? This super community bank idea.
Yeah, they emphasize that model. It's focused on growing client relationships, keeping that core funding strong, and prioritizing safety and soundness. Pretty standard stuff, but they seem committed. They doubled down on organic growth, saying it's working well for them. But they did leave the door open, saying they'd look at opportunistic M&A, mergers and acquisitions. But importantly, they don't feel they need to do a deal.
Right, optionality. What about expenses going forward?
They flagged IT expenses, expect those to rise in the second half of the year as some new systems come online. But they're aiming to offset that increase with more back office consolidation, getting rid of some physical space.
Okay, but that consolidation probably comes with some one-time costs.
Exactly. They guided to expect some non-recurring expenses related to that over the next, say, 3 to 4 quarters. Something to factor in.
All right, so we've unpacked the quarter. Let's connect the dots. What does this all mean for you listening in? What are the bigger signals here?
Well, one big one is the macro environment, specifically those tariffs. Management was pretty direct.
What did they say?
They noted that the uncertainty around international tariffs hadn't really bitten yet because things have been sort of paused. But they gave a clear warning. If those tariffs get readopted, they said it would almost certainly have a negative impact on the West Coast economies.
Oof, that's BANR's core market.
Precisely, especially hitting small businesses and consumers. So that's a major external risk factor you absolutely have to monitor.
That's a critical takeaway. Okay, what about funding competition? Loan growth is hot. Are banks fighting hard for deposits again?
Interestingly, management doesn't seem to think deposit competition is as fierce now as it was, say, a year ago. They believe their relationship banking approach, especially focusing on small businesses which tend to hold decent deposit balances, helps insulate them a bit. That's core to their funding plan.
So going back to those FHLB borrowings.
Right. Management sees those as temporary, a plug, like we said. They actually expect normal seasonal inflows, especially from their agricultural clients in Q3, might mean deposit growth actually outpaces loan growth next quarter.
Which would let them pay down those FHLB advances.
That's the hope. If deposits come in strong, they can reduce reliance on that wholesale funding, which would be good for their funding costs going forward.
Okay, and looking ahead at the net interest margin, the NI. If the Fed just stays put, holds rates steady.
Management expects loan yields should keep ticking up, maybe 4 to 5 basis points per quarter, just from loans repricing and new ones coming on. Combine that with potentially lower FHLB use if deposits cooperate. It suggests maybe more tailwinds than headwinds for their margin in the back half of the year, assuming rates stay stable, of course.
And that point about the new loan mix.
Yeah, it just reinforces that the lower average rate on new loans this quarter wasn't necessarily a sign of weakness. It was more about what kinds of loans they booked. Opportunities seem to be there, particularly in the Pacific Northwest middle market small business. And they're expecting growth out of California, too, with some new bankers they've brought on. Lots of potential drivers for future loans.
Okay, time for our favorite segment. Let's be clear. This is purely for informational fun, a thought experiment. Absolutely not financial advice, just some speculative ideas.
All right, let's get a little wild but plausible with BANR Corp, based on this quarter. Idea 1, the tariff pause alpha play. Basically, you bet that those tariff threats stay just threats or ease up. You go long BAN, maybe pair it with a short on a West Coast company that's really exposed to tariffs, like in logistics or industrials.
Okay, what's the logic?
The idea is BANR's shown it can grow organically even with this tariff uncertainty hanging around. If that cloud lifts, their core West Coast small business clients could really take off. That means potentially better deposit growth, better loan growth than expected, boosting their NIM. You're betting on the regional economy's resilience being the broader trade worries.
Interesting. What's idea 2?
Idea 2, the community bank defensive growth arbitrage. This is more of a relative value play. Go long BAN and short maybe a regional bank ETF, or pick a specific peer bank that looks weaker, maybe less core deposits, more reliant on wholesale funds.
Why BANR specifically?
Because of that 89% core deposit base, the relatively low use of wholesale funds long term, and that focused super community bank strategy. It gives them a structural edge. As their adjustable loans keep repricing up, and if they keep deposit costs stable, BANR could show much better NIM stability and earnings consistency than banks facing funding pressure or with less diverse loan books. Basically, betting their best in class in a potentially tough sector.
2 interesting, definitely speculative angles there. All right, that wraps up our deep dive into BANR Corporation's Q2 2025 earnings call. We've hit the solid results, their focus on organic growth and relationships, credit quality nuances, and those macro factors like tariffs.
Yeah, I think the key takeaways are their consistent execution, that strong capital base, and just how they seem to be navigating the current uncertainty while still finding growth. But definitely those comments on potential future tariff impacts and how they're managing funding dynamically, those are things you really need to keep tracking.
We hope this deep dive gave you some valuable shortcuts to understanding BANR's latest performance. And remember, this is all for educational purposes, definitely not investment advice. Maybe something to think about. How sensitive are the businesses in your area to those bigger global trade winds? It's often more connected than we think. Thanks for joining us. We'll catch you on the next deep dive.